don't notice it, but tonight we'll calmly uncover the hidden mechanics behind. The invisible mechanics behind every loan. When someone seeks to acquire something of value, a process begins. This process is rarely visible to those who initiate it. It operates through channels that extend far beyond the immediate transaction. The person makes a request. The request travels through systems that have been built over generations. These systems evaluate, calculate, and decide. The decision emerges from layers of activity that remain hidden. Most people experience only the surface of this process. They fill out forms. They provide information. They wait for an answer. The answer arrives as approval or denial. What happens between request and response remains largely mysterious. Yet this hidden activity shapes outcomes profoundly. It determines who gains access to resources and who does not. It influences what becomes possible and what remains out of reach. It affects the trajectory of lives and businesses. The system operates continuously. While people sleep, it processes requests. While people work, it makes calculations. It never pauses. It never fully reveals itself. Behind every loan lies an architecture of decisions. Each decision depends on information gathered from multiple sources. The information flows through channels that connect institutions, databases, and evaluation systems. These channels were not created all at once. They developed gradually over time. Each generation added new components. Each innovation built upon previous foundations. The result is a complex network that few fully comprehend. The network handles vast quantities of activity. Thousands of requests enter it every hour. Each request triggers a series of processes. Each process involves multiple steps. The steps occur mostly automatically, guided by rules embedded in systems. Human judgment still plays a role, but the role has changed over time. Where once every decision required individual review, now only certain decisions receive direct human attention. The rest flow through automated channels. This automation reflects accumulated learning. Patterns have been identified through observation of countless past transactions. The patterns have been encoded into algorithms. The algorithms replicate judgments that humans once made manually. The shift toward automation has transformed how quickly the system operates. Decisions that once took days or weeks now occur in minutes or hours. The speed enables economic activities that would not be possible with slower processes. But speed is not the only change. The system has also become more interconnected. Information that once resided in separate locations now flows between institutions. This integration allows for more comprehensive evaluation. When someone requests a loan, the request triggers information retrieval from multiple sources. Past behavior is examined. Current circumstances are assessed. Future capacity is estimated. The examination happens through queries to databases. These databases contain records that have accumulated over years. Every past interaction with the credit system leaves a trace. These traces are stored, organized, and made available for future reference. The reference happens almost instantaneously in modern systems. A query is sent. Data is retrieved. The data is analyzed. Results inform the decision process. This process operates on principles that are not immediately obvious. The principles involve assessment of probability. Based on patterns observed in past data, predictions are made about future behavior. These predictions guide decisions about whether to extend resources. The predictions are never certain. The future cannot be known with complete accuracy. But patterns in past behavior suggest probabilities about future behavior. The system operates on these probabilities. Someone with a history of reliable behavior is deemed more likely to continue that pattern. Someone without such a history, or with a history of unreliable behavior, is deemed less likely to be reliable in the future. The assessments are statistical rather than absolute. This statistical approach means the system sometimes makes errors. Some who would have been reliable are denied access. Some who prove unreliable receive access. The errors are accepted as inevitable given the uncertainty involved. The goal is not perfection but optimization. The system aims to make correct predictions more often than incorrect ones. Over large numbers of decisions, this produces acceptable outcomes even though individual decisions may be wrong. Behind each loan decision lies a calculation of risk. Risk refers to the possibility that promised repayment will not occur. Higher risk requires either denial of the request or compensation through higher cost. The calculation of risk involves weighing multiple factors. Some factors are objective and measurable. Others are subjective and require judgment. The combination of factors produces an overall assessment. This assessment gets translated into a decision. The decision may be binary, approve or deny, or it may be more nuanced, approve with specific terms and conditions. The terms and conditions reflect the assessed risk. Higher risk leads to stricter terms. Lower risk leads to more favorable terms. The variation in terms creates a spectrum of possibilities rather than a single standard offer. Most people seeking loans do not see this complexity. They see only the outcome. They receive either access or denial, favorable terms or unfavorable terms. The mechanisms that produce the outcome remain invisible. Yet these mechanisms are what determine the outcome. Understanding them requires looking beneath the surface. It requires examining the components that make up the system. It requires tracing the flow of information and the application of rules. The system exists because of a fundamental economic need. People and organizations often require resources before they have accumulated sufficient savings. Without a mechanism to access future capacity in the present, many activities would be impossible or delayed. But providing access to future capacity involves uncertainty. The provider must trust that capacity will actually materialize. The provider must believe promises about the future. Trust and belief require foundation. The foundation comes from information about the requester. The more comprehensive and reliable the information, the stronger the foundation. Building this foundation is what the invisible system does. It gathers information from many sources. It synthesizes the information into assessment. It uses the assessments to make decisions. The information gathering happens through multiple channels. Some channels are direct. The requester provides information about themselves. Other channels are indirect. Third parties provide information about the requester. Direct information includes statements about income, employment, and asset. These statements describe current circumstances. They provide a snapshot of present capacity. Indirect information includes records of past behavior. These records show how the person has handled previous obligations. They reveal patterns of reliability or unreliability. Both types of information feed into the evaluation process. Neither type alone is sufficient. Together, they create a more complete picture than either could provide separately. The picture is never perfect. Information is always incomplete. Circumstances change. People change. The future remains uncertain. But the picture is useful despite imperfection. It provides a basis for judgment. It allows decisions to be made when waiting for perfect information would mean waiting forever. The invisible system has evolved to handle imperfect information. It incorporates safeguards and adjustments. It learns from outcomes and refines its processes. It becomes more sophisticated over time. This evolution reflects the accumulated experience of countless transactions. Each loan that is repaid or not repaid provides data. The data reveals which factors were predictive and which were not. Future decisions incorporate these lessons. The learning happens at both individual and systemic levels. Individual lenders adjust their practices based on their experiences. The broader system adjusts through changes in regulation and industry standards. Both forms of learning improve the system's functioning. They reduce the frequency of errors. They enhance the efficiency of resource allocation. They contribute to economic stability. Yet the system remains imperfect. It still makes mistakes. It still faces challenges in predicting an uncertain future. It still must balance competing objectives. Understanding the invisible mechanics means recognizing both capabilities and limitations. The system can process vast amounts of information quickly. It can identify patterns that humans might miss. It can make consistent decisions across many cases. But it cannot eliminate uncertainty. It cannot predict the unpredictable. It cannot guarantee that every decision will prove correct. What it can do is operate systematically. It can apply consistent standards. It can create a framework within which lending activity occurs. It can balance individual risk-taking with collective stability. This balance is crucial. Too much caution and the system fails to serve its purpose of enabling access. Too little caution and the system becomes unstable. Finding the right balance requires ongoing adjustment. The adjustment happens through feedback from outcomes. When many loans perform poorly, standards tighten. When most loans perform well, standards may ease. The system responds to its own result. This responsiveness creates dynamics that affect the broader economy. When lending standards ease, more people gain access to resources. Increased access supports economic activity. When standards tighten, fewer people gain access. Reduced access constrains activity. The invisible system thus influences not just individual outcomes, but collective conditions. Its decisions aggregate into patterns that shape economic environments. These patterns affect everyone, not just those directly seeking loans. Someone who never borrows is still affected by the system. The businesses they work for may depend on borrowed funds. The property values in their area may reflect availability of mortgage lending. The economic vitality of their community may depend on credit access for local enterprises. The pervasive influence of the system makes understanding it valuable. Even those who do not directly interact with it benefit from knowing how it operates. The knowledge provides insight into broader economic patterns and dynamics. But gaining this knowledge requires patience. The system is complex. Its components are numerous. Its operations are multilayered. What follows is an exploration of these components and operations. The exploration proceeds step by step. Each step builds on previous ones. The pace is deliberate to allow understanding without strain. The invisible mechanics behind every loan are the processes, system, and rules that transform a request for resources into a decision about access. At the most basic level, these mechanics involve evaluation. Someone requests resources they do not currently possess. Someone else must decide whether to provide those resources based on a promise of future repayment. The decision requires answering a fundamental question. Will the borrower repay? The question cannot be answered with certainty. The future is unknown, but the question must still be addressed. Addressing it requires gathering information that might indicate likely outcomes. The information comes from various sources and takes various forms. Some information describes the borrower's current situation. Income level, employment status, existing assets, and outstanding obligations all provide relevant data. These factors help establish present capacity. Other information describes the borrower's past behavior. Previous loans, payment histories, defaults or delinquencies all create a record. This record suggests patterns that might continue into the future. Still, other information describes the purpose of the loan and the collateral offered. What the funds will be used for matters. Whether the loan is secured by specific assets affects risk assessment. All this information flows into evaluation systems. These systems apply rules and formulas to generate assessments. The assessments indicate the probability of repayment and the appropriate terms for the loan. The rules and formulas reflect accumulated wisdom about what factors predict repayment. They have been developed through analysis of countless past loans. They encode patterns observed in historical data. When applied to new loan requests, these rules and formulas produce scores or ratings. The scores summarize complex information into simple numbers. The numbers guide decision-making. Higher scores indicate lower risk and typically lead to approval with favorable terms. Lower scores indicate higher risk and may lead to denial or approval with less favorable terms. The scoring process happens largely automatically in modern systems. Computers retrieve data, apply formulas, and generate results. Human involvement occurs primarily at decision points or when unusual circumstances require judgment. This automation enables speed and consistency. Thousands of applications can be processed simultaneously. Each application receives the same objective analysis based on the same criteria. The consistency serves important purposes. It reduces arbitrary variation in outcomes. It ensures that similar situations receive similar treatment. It creates predictability for both lenders and borrowers. But consistency also has limitations. Rules cannot capture every relevant circumstance. Some situations defy standard categorization. Rigid application of rules may produce inappropriate outcomes in exceptional cases. This is why human judgment remains part of the system. Experienced professionals review cases that fall outside normal parameters. They consider factors that automated systems cannot easily incorporate. They make decisions when rules prove insufficient. The combination of automated evaluation and human judgment creates a hybrid system. The automation handles routine cases efficiently. The human element addresses complexity and nuance. Both components are essential. Pure automation would be inflexible. Pure human judgment would be too slow and inconsistent. The hybrid approach balances speed with flexibility. The invisible mechanics also include infrastructure that supports the evaluation process. Databases store vast amounts of information about borrowers and their histories. Communication networks transmit data between institutions. Software systems process applications and generate decisions. This infrastructure has grown tremendously over time. What began as paper records in filing cabinets has evolved into interconnected digital systems spanning the globe. The evolution has enabled capabilities that would have been impossible with earlier technology. Near instantaneous access to information from multiple sources. Analysis of vast datasets to identify predictive patterns. Secure transmission of sensitive data across distances. These capabilities make modern lending fundamentally different from historical lending. Decisions are faster, more consistent, and based on more comprehensive information. The scope of lending activity has expanded accordingly. More people have access to loans than in previous eras. More types of lending products are available. More economic activity is enabled by borrowed funds. This expansion reflects not just technological progress, but also institutional development. The rules governing lending have been refined. The standards for evaluation have been improved. The protections for both lenders and borrowers have been strengthened. Regulatory frameworks establish baseline requirements for lending practices. These frameworks aim to protect consumers from exploitation while allowing efficient lending. They create boundaries within which the invisible mechanics operate. The boundaries include requirements for disclosure. Lenders must provide clear information about loan terms and costs. Borrowers must be able to understand what they are agreeing to. Other boundaries include limits on certain practices. Interest rates may be capped. Specific types of discrimination are prohibited. Minimum standards for creditworthiness evaluation are mandated. These regulatory boundaries shape how the invisible mechanics function. They ensure that lending serves social purposes beyond profit generation. They balance efficiency with fairness. The mechanics also include risk management processes. Lenders recognize that some loans will not be repaid despite careful evaluation. They build systems to handle this reality. One approach is diversification. By making many loans to different borrowers, lenders reduce exposure to any single default. Losses from some loans are offset by returns from others. Another approach is pricing risk into loan terms. Higher risk borrowers pay higher interest rates. The additional interest compensates lenders for greater default probability. A third approach is requiring collateral. Assets pledged as security can be claimed if repayment does not occur. This reduces the lender's loss in the event of default. These risk management approaches are embedded in the invisible mechanics. They operate as part of the standard evaluation and structuring of loans. They help maintain system stability, even though individual loans may fail. The mechanics exist because lending serves an essential economic function. It allows resources to flow from those who have surplus to those who have needs. It enables productive activity that would not otherwise occur. Without lending, economic growth would be constrained by existing savings. Investment in new ventures would require full upfront funding. Large purchases would demand complete accumulated wealth. Lending removes these constraints. It allows future capacity to fund present activity. It enables people and businesses to undertake projects before having saved sufficient funds. But lending also creates obligations. Borrowers must repay. Failure to repay has consequences for both borrower and lender. Managing these obligations requires the systems and processes that constitute the invisible mechanics. The mechanics transform the simple idea of borrowing into a functioning, scalable system. They make it possible for lending to occur safely and efficiently across millions of transactions. Without these mechanics, lending would be limited to personal relationships where trust exists independently. The scale of lending would be tiny compared to what exists today. Many economic activities that are now routine would be impossible. The mechanics thus represent infrastructure comparable to roads or electrical grids. They enable activity that depends on them but is not limited to them. They create the foundation on which lending-dependent economic activity rests. Understanding what these mechanics are means recognizing them as systematic evaluation and risk management processes. Processes that gather information, apply analysis, make decisions, and manage consequences. Processes that operate mostly invisibly but shape outcomes visibly. Processes that have evolved over time and continue to develop. Processes that balance multiple objectives: efficiency, fairness, stability, and growth. These processes are not natural or inevitable. They are human creations that reflect choices about how to organize lending activity. Different choices would produce different systems with different characteristics. The existing mechanics reflect accumulated learning from historical experience. They incorporate lessons from both successes and failures. They represent current best understanding of how to enable productive lending while managing risks. But they remain imperfect and subject to ongoing refinement. As circumstances change, the mechanics must adapt. As new technologies emerge, new possibilities arise. As new problems surface, new solutions are needed. The invisible mechanics behind every loan are thus not static. They are dynamic systems continuously evolving. Understanding them requires recognizing both their current state and their developmental trajectory. With this understanding of what the mechanics are, the next question becomes how they are created and maintained. Where do these systems come from? Who builds and operates them? Through what processes do they come into being and persist over time? The invisible mechanics behind every loan did not emerge all at once. They developed gradually through many incremental innovations and adjustments. The earliest forms of lending were simple and direct. One person lent to another based on personal knowledge and trust. No complex evaluation was needed because the lender knew the borrower personally. As economies grew and communities expanded, personal knowledge became insufficient. Lenders needed ways to assess borrowers they did not know personally. This need drove the development of more systematic evaluation methods. Early systematic methods involved gathering references and testimonials. Others would vouch for the borrower's character and reliability. These endorsements provided some basis for trust beyond personal knowledge. Over time, more objective measures were sought. Records of past transactions began to be kept. If someone had borrowed and repaid in the past, this history suggested they might do so again. The record keeping started locally and informally. Individual lenders maintained their own records of who had borrowed from them and whether repayment occurred. These records were private and not shared. The limitation of private records became apparent. A borrower might default with one lender and then approach another lender who had no knowledge of the default. The second lender faced risk they could not assess. This limitation created demand for shared information. If lenders could access records of borrowing behavior across multiple institutions, they could make better informed decisions. The first credit bureaus emerged to meet this demand. These were organizations that collected information about borrowers from multiple lenders and made it available to their members. The collection was initially manual and laborious. Information arrived on paper. It was organized into physical files. Requests for information required searching through these files. Despite the cumbersome process, the value was clear. Lenders gained access to information they could not obtain on their own. They could assess risks more accurately. They could avoid lending to those with poor payment histories. As the volume of lending grew, the information infrastructure had to scale. Manual processes could not keep pace. Technology was needed to handle larger volumes. Computing technology transformed credit information systems. Digital databases replaced physical files. Electronic transmission replaced paper delivery. Automated queries replaced manual searches. The transformation occurred gradually over decades. Each technological advance enabled new capabilities. Each new capability expanded the scope of what lending could accomplish. Modern credit bureaus maintain comprehensive databases on millions of individuals and businesses. They receive continuous updates from thousands of lenders. They process millions of information requests each day. The creation of this infrastructure involved massive investment. Building databases, developing software, establishing communication networks, and maintaining operations all required substantial resources. The investment was made because the value created exceeded the cost. Better information led to better lending decisions. Better lending decisions reduced defaults and increased profitability. The economic benefit justified the infrastructure expense. Parallel to the development of information infrastructure, evaluation methods became more sophisticated. Early methods were simple and subjective. Lenders made judgments based on limited factors and personal intuition. The desire for more objective and consistent methods drove innovation. Researchers began analyzing historical lending data to identify patterns. They asked which factors best predicted repayment. Through statistical analysis, certain factors emerged as consistently predictive. Past payment behavior was strongly predictive. Income relative to debt obligations mattered significantly. Length of credit history showed relevance. These findings led to the development of scoring models. The models assigned numerical weights to different factors based on their predictive power. A borrower's characteristics were input into the model. The model output a score indicating repayment probability. The first widely adopted scoring model transformed consumer lending. It provided a standardized, objective method for evaluating creditworthiness. Lenders could make faster, more consistent decisions. The scoring approach spread across the lending industry. Different models were developed for different types of lending. Mortgage lending used different factors than auto lending. Business lending differed from consumer lending. But all scoring models shared common principles. They used historical data to identify predictive factors. They quantified the relationship between factors and outcomes. They produced numerical assessments that guided decisions. The development and refinement of these models has been ongoing. As more data accumulates, models become more sophisticated. As statistical techniques advance, predictions become more accurate. The creation of the invisible mechanics also involved establishing standards and regulations. As lending grew in importance, societies recognized the need for rules governing the activity. Some rules addressed fairness concerns. Discrimination based on certain characteristics was prohibited. Borrowers were granted rights to know why they were denied. Accuracy of credit information was mandated. Other rules addressed safety and soundness. Lenders were required to maintain certain financial cushions. Limits were placed on risky lending practices. Oversight institutions were established to monitor compliance. These regulatory frameworks emerged gradually, often in response to problems that had occurred. Each crisis or scandal led to new rules designed to prevent recurrence. The accumulation of rules created complex regulatory environments. Lenders must navigate numerous requirements from multiple authorities. Compliance systems became necessary parts of the lending infrastructure. The invisible mechanics thus include not just evaluation systems, but also compliance systems. These systems ensure lending activity conforms to legal and regulatory requirements. Building and maintaining compliance systems requires ongoing effort. Rules change. New requirements are added. Systems must be updated continuously. The formation of the invisible mechanics also involved developing legal frameworks for enforcing loan agreements. Courts and legal procedures provide mechanisms for resolving disputes. These mechanisms give loan agreements enforceability. Without enforceability, lending would be far riskier. Borrowers might simply refuse to repay with no consequences. Lenders would face losses they could not prevent. Legal enforcement provides consequences for non-repayment. Assets can be claimed. Wages can be garnished. Future credit access can be denied. These consequences create incentives for borrowers to honor their commitments. The incentives make lending viable at scale. They enable the extension of credit to strangers based on objective assessment rather than personal relationship. The legal infrastructure supporting lending has evolved over centuries. Contract law, property law, and bankruptcy law all contribute to the framework. The framework provides the foundation on which modern lending rests. Another element in the formation of the invisible mechanics is the development of secondary markets. These are markets where existing loans can be bought and sold. Secondary markets serve important functions. They provide liquidity to lenders who can sell loans rather than holding them to maturity. They enable specialization, where some institutions originate loans and others hold them. The existence of secondary markets affects how loans are created. Loans are often structured to be saleable. Standards emerge for what makes a loan attractive to secondary market buyers. These standards influence lending practices. Secondary markets also spread risk. Instead of one institution bearing all risk from loans, it makes risk is distributed across multiple holders. This distribution can enhance system stability. The development of secondary markets required creating standardized loan documentation. Buyers needed confidence they understood what they were purchasing. Standardization provided that confidence. It also required establishing trading infrastructure, platforms for matching buyers and sellers, systems for transferring ownership, mechanisms for servicing loans after sale. All these elements had to be created through deliberate effort. They did not emerge naturally. They were built because their benefits justified the effort required. The formation of the invisible mechanics also involved training people to operate the systems. Credit analysts need skills in evaluation. Loan officers need skills in customer interaction. Compliance officers need knowledge of regulations. Educational institutions and training programs developed to provide these skills. Professional associations established standards and best practices. Bodies of knowledge were codified and transmitted. The human capital behind the invisible mechanics is as important as the technological and institutional infrastructure. Skilled professionals make the systems function effectively. The creation of all these components involved coordination across many actors. Lenders, regulators, technology providers, credit bureaus, and others all had to work together. Sometimes coordination happened through formal agreements. Industry associations established standards that members followed. Regulatory bodies mandated requirements that everyone met. Other times, coordination emerged organically. Practices that worked well were copied by others. Innovations that proved valuable spread through competition and imitation. The result is a complex system with many interdependent parts. No single entity designed or built the entire system. It emerged from countless individual contributions over extended time. Yet the system functions as a coherent whole. Information flows between components. Processes connect seamlessly. Outcomes emerge from the interaction of parts. The formation continues today. The invisible mechanics are not finished products, but ongoing creations. New technologies enable new capabilities. New data sources provide new insights. New methods improve accuracy and efficiency. Artificial intelligence and machine learning are recent additions to the toolkit. These technologies can identify patterns in data that traditional methods might miss. They can make predictions with greater accuracy. But they also raise new questions. How to ensure algorithms are fair? How to explain automated decisions? How to maintain human oversight of complex systems? Addressing these questions requires continued development of the invisible mechanics. The systems must evolve to incorporate new capabilities while maintaining essential values. The formation process also includes periodic restructuring in response to failures. When lending systems contribute to economic crises, reforms follow. Rules are tightened. Practices are changed. Safeguards are strengthened. These reforms become new layers in the invisible mechanics. They add complexity but also resilience. They reflect learning from painful experience. Understanding how the mechanics are formed means recognizing them as accumulated innovations built over time. Each generation inherits systems from previous generations and modifies them. The modifications address current needs while building on past achievements. The process is gradual and continuous. Major changes occur alongside minor adjustments. Revolutionary innovations coexist with evolutionary improvements. What emerges is a system far more complex than any individual planned or design. A system that reflects countless decisions and contributions. A system that works despite no one fully understanding all its parts. This complexity is both strength and weakness. It makes the system robust against simple failures, but it also makes the system difficult to predict or control fully. The formation of the invisible mechanics is thus an ongoing human project. People working in many different roles contribute to building and maintaining the systems. Their collective effort creates the infrastructure that makes lending possible at scale. With understanding of how the mechanics are created, attention turns to how they function day to day. What actually happens when someone applies for a loan? How do the systems process requests and generate decisions? What steps occur between application and outcome? The daily functioning of the invisible mechanics begins when someone decides to seek a loan. This decision triggers a sequence of activities that flow through the system. The first step is application. The potential borrower provides information about themselves and their request. The information includes identifying details, financial circumstances, and the purpose and amount of the loan. The application can occur through various channels. In person at a branch or office. Online through a website or mobile application. By phone with an agent. The channel matters less than the information collected. Once submitted, the application enters the lender's processing system. This is where the invisible mechanics begin their work in earnest. The system first verifies the information provided. Income claims are checked against documentation. Employment is confirmed. Identity is authenticated. Verification prevents fraud and ensures accuracy. It protects both lender and borrower from decisions based on false information. After verification, the system retrieves additional information from external sources. A credit report is obtained from one or more credit bureaus. This report contains the borrower's credit history. The credit history shows all past and current credit accounts. Loans, credit cards, mortgages, and other obligations are listed. For each account, payment history is recorded. The history reveals patterns. Consistent on-time payments suggest reliability. Late payments or defaults suggest potential problems. The age and variety of accounts provide context. The credit report also contains a credit score. This score summarizes the credit history into a single number. The number reflects overall creditworthiness based on historical patterns. Higher scores indicate better credit history and lower risk. Lower scores indicate problematic history and higher risk. The score provides a quick initial assessment. But the score alone does not determine the outcome. The system analyzes many factors beyond the score. Income is compared to existing debt obligations. This comparison shows whether the borrower can afford additional debt. If income is barely sufficient for current obligations, taking on more debt may be unwise. The ratio of debt payments to income becomes a key metric. Too high a ratio indicates overextension. The system may deny the application or approve a smaller amount than requested. Assets are also considered. Savings, investment, and property provide financial cushion. They offer backup if income is disrupted. They can serve as collateral to secure the loan. Employment history matters as well. Stable employment suggests stable income. Frequent job changes might indicate instability. The nature of employment affects income predictability. All these factors are input into evaluation models. The models apply complex formulas developed through statistical analysis. They produce scores and assessments that guide the decision. For standard applications, the evaluation happens automatically. The system processes the input, applies the models, and generates a recommendation. The recommendation indicates approval or denial and suggests appropriate terms if approving. For applications that fall outside normal parameters, human review occurs. A credit analyst examines the details. They consider factors the automated system might not handle well. They use judgment to reach a decision. The decision may be immediate for simple cases. More complex applications require additional time. The borrower receives communication about the decision and the reasons for it. If approved, the loan moves to documentation and closing. Legal documents are prepared specifying all terms and conditions. The borrower reviews and signs these documents. The signing creates a binding legal commitment. Once documents are executed, funds are disbursed. The money transfers to the borrower or directly to the intended recipient. For a home purchase, funds go to the seller. For other purposes, funds go to the borrower's account. With disbursement, the ongoing servicing phase begins. The loan must now be managed throughout its life. Servicing includes sending payment reminders and processing payments received. Each month, a bill or statement is generated. The borrower makes payment according to the agreed schedule. The servicing system tracks payments against what is owed. It calculates how much goes to principal and how much to interest. It updates the outstanding balance. When payments arrive on time, the process is routine. The system processes them automatically. No human intervention is needed. When payments are missed, the system responds. Reminders are sent. Fees may be assessed. After a certain period, more serious collection efforts begin. The collection process follows defined procedures. Contact attempts escalate. Legal remedies may be pursued. The goal is to recover funds while treating borrowers fairly. Throughout the loan's life, information flows to credit bureaus. On-time payments are reported. Late payments are reported. The information updates the borrower's credit history. This reporting completes a feedback loop. Behavior on current loans affects future loan applications. The system learns from outcomes and adjusts future predictions. Some loans are repaid early. The borrower pays off the remaining balance before the scheduled end date. The system processes the payoff and closes the account. Other loans run to full term. After the final payment, the loan is satisfied. The obligation is discharged. The borrower's commitment is fulfilled. Still other loans end in default. The borrower cannot or does not repay as promised. The lender must then try to recover what they can. If collateral secures the loan, the collateral can be claimed and sold. For an auto loan, the vehicle is repossessed. For a mortgage, the property is foreclosed. If no collateral exists, recovery is more difficult. Legal judgments may be pursued. Collections agencies may be engaged. Often only partial recovery is possible. The losses from defaults are absorbed by the lender. This is why risk assessment is so important. Better prediction of defaults reduces losses. The daily functioning also includes portfolio monitoring by lenders. They track the performance of all outstanding loans collectively. They identify trends and patterns. If defaults are rising in certain segments, standards may be adjusted. If profits are lower than expected, terms may be changed. The system continuously adapts based on results. Regulatory oversight adds another layer to daily functioning. Lenders must report to regulatory authorities. They must demonstrate compliance with requirements. They face examinations and audits. The oversight ensures lending occurs within legal boundaries. It protects borrowers from abuse. It promotes stability of the financial system. All these activities constitute the day-to-day functioning of the invisible mechanics. Applications are processed. Decisions are made. Loans are serviced. Information flows. Adjustments occur. The activities are mostly routine. They follow established procedures. They occur millions of times daily across the economy. Yet each instance matters to those involved. For a borrower, approval or denial affects life possibilities. For a lender, each loan represents risk and potential return. The mechanics handle these significant individual outcomes through systematic process. The system treats each case according to general rules while allowing for specific circumstances. Understanding daily functioning means recognizing the balance between automation and judgment, between consistency and flexibility, between efficiency and thoroughness. The systems have been designed to achieve this balance. They process routine cases quickly and consistently. They allow human involvement when needed. They adapt to changing conditions over time. The functioning is invisible to most participants. Borrowers see only the interface, application, and decision. They do not see the information retrieval, the model execution, the risk assessment, the portfolio monitoring. But all these hidden activities determine the visible outcome. The mechanics work behind the scenes to produce the results that borrowers experience. The reliability of this functioning matters enormously. Millions of people and businesses depend on access to loans. If the mechanics failed, economic disruption would be severe. Maintaining reliability requires constant attention. Systems must be monitored and maintained. Problems must be identified and corrected. Updates must be implemented as conditions change. The invisible mechanics of lending are thus not passive infrastructure. They are active systems requiring ongoing operation and management. They function reliably because people and organizations work to make them function. But the systems do not operate in isolation. They connect to and interact with many other systems and institutions. These connections shape how lending affects the broader economy. The invisible mechanics behind every loan exist within a larger ecosystem of economic and financial systems. These systems interact in ways that amplify effects and create feedback loops. The most direct interaction is with the banking system. Banks are not just lenders, but also holders of deposits. The deposits provide funds that banks can lend. The relationship between deposits and loans is fundamental to banking. When a bank makes a loan, it creates a deposit in the borrower's account. This deposit is new money added to the money supply. The loan creation process thus expands money available in the economy. When loans are repaid, deposits disappear. The money supply contracts. The lending activity of banks directly affects how much money exists. This connection between lending and money supply makes the invisible loan mechanics significant for monetary conditions. When lending expands rapidly, money supply grows. When lending contracts, money supply shrinks. Central banks monitor and influence these dynamics. They adjust interest rates to encourage or discourage lending. Lower rates make lending more attractive. Higher rates make lending less attractive. The loan mechanics respond to these central bank actions. When rates fall, borrowing increases because debt becomes cheaper. Loan applications rise. Approval rates may increase. Economic activity accelerates. When rates rise, the opposite occurs. Borrowing becomes more expensive. Demand for loans decreases. Standards may tighten. Economic activity slows. This transmission mechanism works through the invisible mechanics. Central bank policy affects conditions under which loan decisions are made. The decisions aggregate into patterns that shape economic outcomes. The mechanics also interact with financial markets. As mentioned earlier, loans are often sold in secondary markets. Investors purchase loans or securities backed by loans. The prices in these markets reflect investor assessment of loan quality and risk. When investors are confident, they pay higher prices for loans. Higher prices mean lenders can sell loans profitably and make more loans. When investors are worried, prices fall. Lower prices make lending less profitable. Lenders may reduce loan volume in response. Market conditions thus feed back into lending activity. The invisible mechanics are influenced by forces beyond the direct lender-borrower relationship. Asset markets also interact with loan mechanics through collateral values. Many loans are secured by assets like real estate or securities. The value of collateral affects loan decisions. When asset prices are rising, collateral values increase. Borrowers can obtain larger loans against the same assets. Lending standards may ease as higher collateral provides more protection. When asset prices fall, collateral values decline. Existing loans may become under-collateralized. New lending typically becomes more conservative. Standards tighten as lenders seek greater protection. This creates a feedback loop between lending and asset prices. Easy lending can push asset prices higher as more buyers enter markets with borrowed money. Higher prices enable more lending. The cycle reinforces itself. Eventually, the cycle reverses. When prices stop rising or begin falling, lending contracts. Reduced lending means fewer buyers. Fewer buyers pushes prices lower. The downward spiral can be sharp. The loan mechanics amplify these cycles through their role in making credit available or scarce. The availability of credit affects demand across many markets. Housing markets are particularly sensitive to lending conditions. Most home purchases involve mortgages. When mortgage lending is easy and affordable, housing demand is strong. When mortgage lending is tight and expensive, demand weakens. The mechanics of mortgage underwriting thus significantly affect housing markets. Changes in lending standards ripple through housing prices and construction activity. Auto markets show similar patterns. Most vehicle purchases involve financing. Auto lending standards affect how many people can buy cars. Demand for vehicles follows lending availability. Business lending interacts with labor markets. When businesses can borrow easily, they invest in expansion. Expansion creates jobs. More employment means more income for households. When business lending tightens, investment slows. Hiring decreases or layoffs occur. Unemployment rises. Household incomes decline. These changes in employment and income then affect consumer lending. Unemployed people cannot qualify for new loans. They may struggle to repay existing loans. Defaults increase. Rising defaults cause lenders to become more cautious. Standards tighten further. The cycle of contraction continues. The loan mechanics thus interact with labor markets through both business lending and consumer lending channels. Employment conditions affect loan performance. Lending availability affects employment levels. Government fiscal activity interacts with loan mechanics through multiple channels. Government borrowing competes with private borrowing for available funds. Heavy government borrowing can affect interest rates and credit availability for others. Government spending and taxation affect incomes and business conditions. These macroeconomic effects influence loan demand and repayment capacity. Fiscal policy shapes the environment in which lending occurs. Government also directly participates in lending through specialized programs. Student loans, agricultural loans, and small business loans often involve government backing or direct provision. These programs expand credit access beyond what private markets would provide. The interaction between government and private lending shapes overall credit availability. In some areas, government programs dominate. In others, private lenders are primary. The mix affects who can access credit on what terms. Educational systems interact with loan mechanics through student lending. The availability of student loans affects educational access. More available lending enables more people to pursue education. The debt incurred for education then affects borrowers' future financial capacity. Student loan obligations reduce ability to borrow for other purposes. They influence career choices and life decisions. The loan mechanics of student lending thus shape educational patterns and subsequent economic outcomes. They affect social mobility and human capital development. Healthcare financing interacts with loan mechanics in some systems. Medical debt can affect credit scores and access to other forms of credit. Medical lending enables treatment that might otherwise be unaffordable. The connection between healthcare and credit affects how health conditions translate into financial outcomes. Medical problems can become financial problems through debt accumulation. Technology systems increasingly interact with loan mechanics. Digital platforms enable new forms of lending. Mobile applications make applying for loans easier. Data analytics improve risk assessment. Alternative data sources beyond traditional credit bureaus are being incorporated. Utility payment histories, rental payment records, and other information can supplement credit reports. This may expand access for those without traditional credit histories. But technology also raises questions about privacy and fairness. More data collection means more tracking of behavior. Algorithmic decision-making can be opaque and potentially biased. The interaction between technology and loan mechanics is actively evolving. New capabilities are emerging, while new challenges must be addressed. Social networks interact with lending in some newer models. Peer-to-peer lending connects borrowers and lenders directly through online platforms. Social connections sometimes influence lending decisions. These alternative models operate alongside traditional lending. They use similar underlying mechanics but different institutional structures. They expand the range of lending arrangements available. Insurance systems interact with loan mechanics through various protections. Mortgage insurance protects lenders when borrowers make small down payments. Credit insurance can cover loan payments if borrowers become disabled or unemployed. These insurance products affect risk calculations in lending. They enable lending that might otherwise be too risky. They redistribute risk from lenders to insurers. Legal systems interact with lending through enforcement mechanisms. The ability to enforce loan agreements through courts affects lender willingness to lend. Strong legal protection encourages lending. Weak protection discourages it. Bankruptcy laws affect how defaults are handled. They balance protecting creditors' rights with giving borrowers fresh starts. The balance influences lending standards and terms. Different legal frameworks in different places create variation in how lending operates. The invisible mechanics adapt to local legal contexts. Cultural factors interact with loan mechanics through attitudes toward debt. In some cultures, borrowing is normalized and accepted. In others, it carries stigma. These attitudes affect demand for loans and comfort with debt. The mechanics must operate within these cultural contexts. Marketing, product design, and policies reflect cultural expectations. All these interactions mean the loan mechanics are deeply embedded in broader social and economic systems. They affect and are affected by multiple domains. Changes in one area ripple through to others. Understanding the mechanics requires recognizing these interconnections. Lending is not isolated activity, but part of a larger whole. The whole functions through these multiple interactions and feedback loops. The complexity of interactions creates both stability and vulnerability. Multiple connections provide redundancy and alternative paths, but they also create channels for problems to spread. When loan mechanics malfunction, effects can cascade through all connected systems. This possibility makes stability of lending important not just for lenders and borrowers, but for everyone. The invisible mechanics behind every loan are designed to function reliably under normal conditions. But conditions are not always normal. Sometimes the mechanics come under stress. Stress can arise from various sources. Economic downturns reduce incomes and increase unemployment. Asset price declines reduce collateral values. Unexpected events disrupt normal patterns. When stress emerges, the mechanics must adapt. The adaptation begins with rising defaults. More borrowers struggle to make payments. Late payments increase. Delinquencies rise. Rising defaults trigger responses from lenders. They review their portfolios to identify problems. They increase reserves to cover expected losses. They tighten lending standards to reduce new risks. Tightened standards mean fewer approvals. Loan applications that would have been approved under normal conditions are now denied. Terms become less favorable for those who do get approved. The reduced credit availability affects economic activity. Businesses cannot expand or even maintain operations. Consumers cannot make planned purchases. Economic growth slows or reverses. The slowdown worsens the original problem. More businesses fail. More people lose jobs. Incomes decline further. Defaults increase more. This negative feedback loop can become severe. Each step down makes the next step down more likely. The mechanics amplify stress rather than absorbing it. In extreme cases, stress becomes crisis. Lending may nearly cease, even for credit-worthy borrowers. Fear dominates decision-making. Normal evaluation processes are abandoned in favor of extreme caution. Credit crises have occurred periodically throughout history. Each has involved breakdown of normal lending mechanics. Each has caused severe economic damage. The severity of these episodes has motivated efforts to build stability into the mechanics. Multiple layers of protection have been added over time. One layer is capital requirements for lenders. Lenders must maintain equity cushions that can absorb losses. Regulatory minimums ensure these cushions are adequate. When losses occur, they deplete the cushion rather than threatening the lender's viability. The lender can continue operating even as some loans default. Another layer is liquidity requirements. Lenders must hold assets that can be quickly converted to cash. This ensures they can meet funding needs even when market conditions deteriorate. Liquidity prevents temporary funding problems from becoming permanent failures. Solvent lenders can weather short-term stress. Reserve requirements provide a third layer. Lenders set aside funds specifically to cover expected loan losses. The reserves build during good times when losses are low. They provide cushion during bad times when losses rise. These prudential safeguards operate at the individual lender level. They make each lender more resilient to stress. System-wide protections add another layer. Deposit insurance prevents bank runs by guaranteeing deposits. Depositors know their funds are safe even if the bank fails. This knowledge prevents panic withdrawals. Central banks serve as lenders of last resort. When private funding dries up, central banks can provide liquidity to solvent institutions. This backstop prevents liquidity crises from becoming solvency crises. Regulatory supervision provides ongoing monitoring. Regulators examine lenders regularly. They identify problems early. They require corrective action before problems become severe. Stress testing has become a standard tool. Regulators require lenders to model how they would perform under adverse scenarios. The tests reveal vulnerabilities before they manifest in reality. If stress tests show inadequate resilience, lenders must strengthen their positions. They raise capital, reduce risk, or adjust strategies. The process builds stability preemptively. Legal frameworks provide orderly resolution mechanisms. When lenders do fail despite safeguards, processes exist for winding them down. Assets are sold, obligations are met to the extent possible, and operations are ceased without chaos. For borrowers, bankruptcy laws provide procedures for handling unpayable debts. Rather than perpetual obligation, borrowers can receive discharge of debts after liquidating assets and following defined processes. These discharge mechanisms serve important functions. They allow borrowers fresh starts. They provide certainty to lenders about recovery prospects. They enable orderly resolution of impossible situations. Despite all these safeguards, stress still occurs. The mechanics cannot eliminate all risk. They can only manage it to acceptable levels. Understanding stress and failure means recognizing inherent limitations. The mechanics depend on predicting uncertain futures. When futures surprise, predictions fail. Mass unexpected events cannot be fully prepared for. Natural disasters, pandemics, wars, and other shocks can overwhelm normal risk management. The mechanics must handle not just predictable variation, but also unpredictable disruption. This challenge has no perfect solution. Systems can be made more resilient, but never completely immune to failure. The goal becomes limiting damage when failures occur, containing problems rather than eliminating them entirely, ensuring failures do not cascade into broader collapse. Recent innovations have added new tools for managing stress. Countercyclical capital buffers require lenders to hold more capital during booms. The extra capital provides cushion when boom turns to bust. Macroprudential policies address systemic risks beyond individual institution safety. They consider how lending patterns affect overall economic stability. They may constrain lending in overheating sectors even when individual loans seem sound. These system-level approaches complement institution-level safeguards. They recognize that collective lending behavior matters beyond individual decisions. Recovery from stress involves gradual restoration of confidence. As conditions stabilize, defaults decline, losses moderate, lenders cautiously expand lending again. The expansion is typically slow at first. Fear lingers even as conditions improve. Standards remain tight longer than economic conditions might warrant. Eventually, normal functioning resumes. Applications flow, decisions are made, loans are approved. The mechanics operate routinely once again. But memory of stress influences future behavior. Standards may remain somewhat tighter than before. Lenders and borrowers may be more cautious. The experience teaches lessons that affect future decisions. This learning process is how the mechanics evolve. Each episode of stress reveals weaknesses. Reforms address the weaknesses. The system becomes more robust. Yet new weaknesses inevitably emerge. Financial innovation creates new risks. Changed circumstances expose new vulnerabilities. The process of identifying and addressing problems continues. Stability in lending mechanics is thus dynamic rather than static. The systems must continuously adapt to remain functional. They operate in changing environments with evolving risks. The mechanics have proven remarkably resilient over time. Despite periodic crises, lending continues to function. The systems recover from stress and resume operation. This resilience reflects the value the mechanics provide. They serve essential economic functions. Society invests in maintaining them because the alternative would be worse. Understanding stress and stability means recognizing both vulnerability and strength. The mechanics can fail, but are designed to limit failure's scope. They face challenges, but adapt to meet them. Perfect stability is impossible when dealing with uncertain futures and human behavior. What is achievable is adequate stability, most of the time combined with mechanisms to restore stability when disrupted. This practical approach acknowledges reality while managing it as best as possible. The invisible mechanics embody this approach in their design and operation. With this understanding of how the mechanics handle stress, the full picture is nearly complete. The various aspects have been explored from multiple angles. What remains is to revisit the key concepts once more, allowing them to settle more deeply. The invisible mechanics behind every loan are the systems and processes that connect borrowers with lenders. They operate continuously, processing requests and making decisions. They remain largely unseen by those who interact with them. Yet they shape economic outcomes profoundly. Understanding these mechanics requires recognizing their components and functions. The components include information systems that gather and store data about borrowers. They include evaluation models that assess creditworthiness. They include decision processes that approve or deny loan requests. They include servicing systems that manage loans throughout their lives. All these components work together to make lending possible at scale. The mechanics developed gradually over generations. Early lending was personal and informal. As economies grew, more systematic approaches became necessary. Information sharing emerged to reduce risk. Evaluation methods became more sophisticated. Technology enabled processing of larger volumes. Regulations established standards and protections. The accumulated innovations created the current system. A system far more capable than what existed in earlier eras. The daily functioning of the mechanics involves many steps. Applications are received and verified. Information is retrieved from multiple sources. Evaluations are performed using established models. Decisions are made and communicated. Approved loans are documented and funded. Ongoing servicing tracks payments and manages accounts. All these activities occur millions of times daily. The routine operation makes lending accessible and reliable. But the mechanics do not operate in isolation. They interact with banking systems that create money through lending. They connect with financial markets that trade loans and securities. They influence asset markets through their role in financing purchases. They affect employment through business lending. They shape educational access through student lending. The interconnections mean lending affects the entire economy. Changes in lending conditions ripple through many domains. This broad influence makes the mechanics significant beyond lending itself. The mechanics can experience stress when conditions deteriorate. Economic downturns, asset price declines, and unexpected shocks create challenges. Rising defaults trigger cautious responses from lenders. Reduced lending availability slows economic activity. The feedback can create negative cycles. But safeguards exist to maintain stability. Capital requirements protect lender solvency. Liquidity requirements ensure funding availability. Deposit insurance prevents panic. Central banks provide backstop support. These protections help the system weather stress. They cannot eliminate all risk but can limit damage. The goal is adequate stability rather than perfect stability. The mechanics reflect pragmatic approaches to managing uncertainty. Understanding all this means seeing lending as systematic process. Not random or arbitrary, but structured and rule-based. Not simple, but composed of many interconnected parts. Not static, but continuously evolving. The invisible nature of the mechanics means most people never observe them directly. They see only outcomes, approval or denial, favorable or unfavorable terms. The processes that produce the outcomes remain hidden. Yet those processes determine what becomes possible. They shape who can purchase homes, start businesses, or pursue education. They influence economic growth and stability. They affect distribution of opportunity, all while operating mostly out of view. This invisibility is both feature and limitation. It allows the mechanics to function efficiently without requiring constant attention. But it also means few fully understand how decisions are made. The lack of transparency can create frustration when outcomes disappoint. Understanding the mechanics does not require technical expertise. The core concepts are accessible through patient reflection. Lending connects those with surplus resources to those with present needs. The connection requires trust that promises will be kept. Building that trust requires information about those making promises. The information flows through systems designed to gather, store, and analyze it. The analysis produces assessments of likelihood that repayment will occur. The assessments guide decisions about whether to lend and on what terms. These fundamental principles apply regardless of specific implementation. Different lending systems implement them differently. But all functional lending systems must address the same basic challenges. How to assess reliability when lending to strangers. How to price risk appropriately. How to handle defaults when they occur. How to maintain stability despite uncertainty. The invisible mechanics represent solutions to these challenges. Solutions developed through experience and refined over time. Solutions that enable modern economies to function as they do. Without these mechanics, economic activity would be far more limited. Growth would be constrained by accumulated savings. Large purchases would require years of saving first. Business expansion would wait for complete self-funding. Many activities taken for granted would be impossible. The mechanics enable economic possibilities by bridging time. They allow future capacity to fund present action. They transform promises about tomorrow into resources available today. This time-bridging function is their essential contribution. Everything else serves to make this function possible at scale. The information systems ensure promises are informed by relevant data. The evaluation methods ensure consistent assessment of promise reliability. The servicing systems ensure promises are tracked and enforced. The stability mechanisms ensure the whole system can continue functioning. Together, these elements create infrastructure for lending. Infrastructure that requires ongoing maintenance and operation. Infrastructure that evolves with changing technology and circumstances. Infrastructure that shapes economic outcomes while remaining largely invisible. The shaping happens through countless individual decisions that aggregate into patterns. Each loan approval or denial affects one borrower's situation. But millions of such decisions collectively determine credit availability. Credit availability influences economic activity levels. Activity levels affect employment, income, and growth. The mechanics thus matter far beyond individual transactions. They represent foundational economic infrastructure comparable to transportation or communication networks. They enable activities that depend on them but extend far beyond them. Understanding this infrastructure provides insight into economic functioning. It reveals why certain patterns emerge, why access to resources varies, why economic conditions fluctuate. The invisible mechanics are part of the explanation. Not the only part, but an important part. They interact with other factors to produce observed outcomes. Technology, policy, culture, and circumstance all matter. But the mechanics provide the framework within which lending occurs. The framework shapes what is possible and what is not. It influences who benefits and who struggles. It affects the pace and pattern of economic change, all while remaining mostly out of sight. This exploration has made the invisible somewhat more visible. The components have been identified. The processes have been described. The interactions and implications have been examined. What emerges is a picture of complex systems serving essential functions. Systems built gradually through human effort over time. Systems that reflect both capabilities and limitations. Systems that enable modern economic life while remaining imperfect. The mechanics will continue to evolve. New technologies will enable new capabilities. New challenges will require new solutions. New understanding will improve functioning. But the fundamental purpose will remain: to connect borrowers and lenders across time. To enable promises about the future to create possibilities in the present. To make lending possible at the scale required by modern economies. This purpose gives the invisible mechanics their importance. This purpose explains why they receive ongoing investment and attention. This purpose justifies understanding how they work. The understanding need not be complete to be valuable. Grasping the basic concepts and principles suffices. Recognizing that systematic processes underlie loan decisions. Seeing how information flows and shapes outcomes. Understanding that risk assessment drives decision making. Appreciating that stability requires ongoing effort and adaptation. These insights illuminate economic functioning. They reveal order within apparent complexity. They make the invisible at least partially visible. And in that visibility comes understanding. Understanding of how promises become loans. How loans enable economic activity. How activity creates prosperity and opportunity. All supported by invisible mechanics working quietly behind every loan.